Okay, go ahead, Kurt.
Okay. It's 2:00 Hawaii time, so we're calling the Council of Revenues meeting to order for January 5th, 2023. Dr. Kobe, is there any communications to the council or public comment?
None.
Maybe we'll wait for about, see if anyone makes a comment on the chat.
Yeah, so if anybody would like to make a public comment or public testimony, if you could just type in on the chat or the Q&A function, and we will respond to you. I don't think we have gotten anything, Kurt.
Okay. We don't have any comment or communication to the council. So that should be noted. And next item on the agenda is the minutes of the meeting from October 27, 2022. And that was a personal income meeting. Any comments on the minutes? Any motion to approve the minutes?
Make a motion.
Second.
Okay. Vote to approve the minutes from the meeting on October 27, 2022 on total personal income. Vice Chair Nuwal?
Yes.
Siderhout?
Yes.
Dr. Bonham?
Yes.
Councilmember Maynard?
Yes.
Councilmember Lee, Hayashi, I'm sorry, Hayashi.
Yes.
Councilmember Lee?
Yes.
Okay, so the minutes are approved unanimously. Okay, next item, I believe, where is this year presentation review of revenues and constitutional tax refund?
Yes. Can I share my screen?
Sure. Do I?
It's,
Do I have it?
I'm sorry, I'll take care of it. You guys should be able to.
I see the share.
You see the, okay.
Yes.
So welcome everybody. So the big news for this meeting is a constitutional refund, right? So in September we met and there was a miscommunication and we hadn't finally made the decision. We knew about the constitutional refund, but we thought this was going to be treated like appropriations issue, and it's not, right? It has to go through the tax system, which means it has to have impact on the revenues. So I really apologize for that. I take responsibility for not including that in the fiscal, the revenue impacts of legislation that was passed in the previous from the previous legislature. However, we're going to be dealing with it now. So if you guys have been following the preliminary statements, they've been lower than what we were expecting. And the reason is essentially the constitutional refund. So we have projected that it was going to cost $334 million, the constitutional refund, which is about 3.6% of the growth rate of the 2022. So the easy way to think about everything is you just take whatever number you already had in mind and subtract, your growth number, whether that was 6 or 9 or 3, and subtract 3.5% from it, right? It has been, most of the distribution occurred in September and October. A little bit have gone out in November. We expect the revenue impacts to continue, but it'd be very, very small, like $1 or $2 million going forward. So all of the impact was really in the first half of the fiscal year, and going forward, we don't really anticipate having a significant fiscal impact or revenue impact. It might, in fact, impact it by $1 or $2 million, but nothing that's large enough to really drive revenues on a monthly basis. Does anybody have any questions about that?
How was the refund administered? It wasn't based on, was it just automatically sent out? It wasn't based on like filing a return. They didn't have to file a return.
Yeah, it was.
Right?
you had to file a fiscal 2022 or 2021 return, and you had until the end of last year to amend your return to ensure that you received the tax credit, right? The
Did you actually
Constitution.
did they actually claim the credit on the form?
No, nobody had to do anything on a tax form. All you had to do was
File
file your
return.
taxes
file,
in
yeah.
2021.
Okay.
Mhm. And then everything was automatically sent out. Most of that was sent out electronically, and that's where I'll show you how things progressed month by month. But most of it occurred in September and October, and then it's been really small since. But I'll show you how things played out by month. Just as a reminder, it was $100 per exemption for anybody who made over $100,000 and $300 per exemption for anybody making less than $100,000.
And when you say it was
AGI,
sent
federal.
electronically, it was just automatically deposited in their bank accounts.
Correct. Yeah.
Okay.
So the Department of Taxation normally has people's bank account information because we issue refunds all the time. So we use this. If we did not have that, we issued a paper check.
There were no issues like I know sometimes when we have either constitutional refunds or, sometimes you have people that scam the system or, take advantage of the system. No
Yeah.
significant issues with that.
None. I mean, we took our normal precautionary or measures and things like that. However, there was no significant issues in that area.
Thank
Okay. So this is, our normal preliminary, right? And so this is a preliminary up until December. This is not the official one, but it's going to come out, right? So there's a bunch of things I'm going to highlight here. One is the area on the left outside of the box is without it being adjusted for the constitutional refund, and on the right hand side is the adjustments with the the area on the left hand side is with the constitutional refund, and the area on the right, the small block, is without the constitutional refund. So I just want to highlight things. I'm going to
So
go
in other words, the area on the right is what would have happened if there had
Yes.
been no refund.
Correct. Yes.
And,
So I
and
adjusted
would be
it.
the most consistent with what we had forecast.
Correct. So I'll just take you through a bunch of different lines so you'll have an idea. So the GET, it continues to be going very strongly. We're up 13.5% on the year. Corporate income tax, it's up, but remember, this is a very volatile tax and actually one of our smaller tax types. So I don't spend as much time trying to figure that out. The individual income tax, so we're down 17.5%. However, if we correct, so if you come down and look at, we included a new line in the preliminary so everybody could see the constitutional refund. That's different from the normal refunds, right? So up until this year, or up until now, we've dispersed $309 million, right? In the month of December, we dispersed $921,000, right? So this suggests that most of the constitutional refunds are already out the door, right? There's going to be a couple million more, but it's going to be small compared to, just to put this in perspective, I believe this number was over 200 million in September. So it's quite significant, right? But basically, if we adjust it, what we're adjusting it about is this constitutional refund amount of 309 million. If we add this back in, we're up 3% on the year. So the individual income tax is growing. It's not growing as quickly as other tax types. So what is really driving this? So the biggest one we always look at, or the one I always look at first, is withholding on taxes and wages, right? This is your normal salaries. This is up 7.9% on the year, which is pretty healthy. In fact, payments with returns is doing pretty good, even though this is smaller. So the big one is declared estimated taxes, right? It's just smaller this year. That's one of the big question marks that I'm trying to resolve, and it'll be your responsibility. Is why is declared estimated taxes going down? One possibility is the stock market. Another one is that actually inflation is really squeezing businesses, right? And so, S corps, partnerships, they pay their taxes through their, yeah. income taxes, and so maybe they're just making less money because of inflation. We don't really have an answer to this, but really what's driving our declared estimated tax, or the low performance of individual income tax once the constitutional fund has been adjusted, is declared estimated taxes. So that's just something to keep in mind. Our transit and accommodation taxes remain strong. So, as well as the other taxes. So with the constitutional refund, we're up 2.1% as of December for the first 6 months of the year. Without it, we would be up 9.6%.
Seth,
Yes.
question regarding the collections by DOTAX and other departments.
Mm-hmm.
Prior periods and that collections, is that collections from audits?
No, the collections from, if a collection from audit, it goes back to the original tax type. Collected by DOTAX is kind of like the tobacco tax, the environmental. We have a bunch of really small tax types that we don't put there in the preliminary. And then for other departments, that's the conveyance tax and the insurance premium tax, which is not administered by the Department of Taxation.
So for example, with the GETAX, there's no breakdown as far as how much was collected normally versus how much is past due.
Correct.
Okay.
And remember, this is not total tax liability. This is essentially accounting, right? This is the money we receive every month through the door.
Right.
Right.
I understand what it is. Cash basis collections of
Yeah.
GET.
Yeah,
Which
of all our
includes
tax types.
current taxes and past taxes.
Okay, so this is just a nice graph that I wanted to show you of our monthly general fund collections, right? So the orange line, or the lighter orange line, that goes all the way across, that's fiscal year 22. And then I have two lines here. One shows you the actual collections, which is the solid line, the solid red line, and the dotted red line is the adjusted amount that we would have if we had not had the constitutional refund. And what you'll see is, in August, there was no, July and August, there was no impact. September, we saw the largest impact. In October, we saw another big divergence. It's getting pretty small in November, and December, you couldn't even tell it. So just another way of explaining to you guys that the constitutional refund did have a really big impact on the months of September and October, and that's where we're seeing things, and we don't expect to have a big impact going forward.
Seth, one more
Yep.
question.
Mhm.
They're talking about possibly having another refund going out to, that's what I seem to have read. Do you happen to know what that was about?
Yes, so that was a comment made by the new BNF director, Salviera, and he was saying that they do expect some tax law changes coming up, one of which could be a constitutional refund, or it could be through some other tax refund measures. That's what he said.
Okay, so that will be for next year, not for this year.
Correct. Everything is
We'll be worrying about that in May
Yeah.
or later.
Mm-hmm. Yeah, and really, if they are interested in the individual income taxes, it really would not affect this fiscal or anything in calendar year 2023, unless they did something backwards looking. Okay, so just as a reminder, this shows that our GET revenue, which is like kind of the most real-time indicator of our economy in terms of how tax revenues are doing, it remains really strong, especially compared to last year's, right? And that, I'm sure that has something to do with inflation, has something to do with visitor arrivals returning and life getting back to normal. Just to put this in perspective, this is pretty common for other states, right? All states at the state level, not necessarily the federal level, all states are seeing really high, most states are seeing very high levels of tax revenues, much higher than they've ever seen before. So this is something that's occurring all over the country for except for states that are highly dependent on energy extraction and extraction of natural resources for their taxes. This is something I always do for you guys, but this is the current forecast. So your current forecast is 6.5, 4, 3.5, 3.5, 3.5, 3.5, right? I'll show you, I wanted to include this. This is our Model 1 forecast, right? So this is our most, I would say, the most accurate model that we have. And we've did two things here. One, we showed it without the constitutional refund. So if we took the mean of all your forecasts and plugged it in, we get something like 9.6% for the year. And then it declines to 6%, and then it comes all the way down. This is your input that you guys are providing, right?
Okay, hold on though.
Yep.
But that's the input from this, for this meeting.
Yes, for this meeting.
So then it does include the constitutional refund because most of it's already in the data, unless people didn't bother to look at the data.
Well, our model did
So
not
it's an
adjust
annual
for that.
model,
Yeah, it's an annual
Yeah.
model. So
right?
just
Okay.
to be clear, so this one does not adjust for it, and then this blue line does adjust for it, right? And so what we do is we took out $336 million out of your forecast, or out of the output of the model. Use your forecast, and this is what we get, which is like, I think it's 5.8%, right? So if you believe the model, and then we subtracted out the constitutional refund, that would be 5.8%, and then it would go up to 9.5%, and then it would come down and just follow the exact same thing. So I just wanted to include that out there, that this is what the green is what the model is showing without the constitutional refund, and the blue is what it's showing with the constitutional refund. Okay, we last time we just had a quick discussion about how the models do relative to the overall consensus forecast. So we did a little bit more research. We're still ongoing. We've been really busy, so I apologize. We haven't done as much research as we wanted, but I just wanted to highlight a couple things because there are some questions about the accuracy of the model. So the top is the core forecast, right? And the difference between the actual and the forecast. So if you remember, September 2021 was a crazy year. We thought we were just coming out of the pandemic. We weren't sure. And so like the core made a guess of 6.3. It was actually 29.1%. So that's the difference, right? And you can see it for every single one. Now below is the model forecast that's based on your inputs, right? So our model is only as good as your inputs. So, and what you kind of see is if you go from the September to the January to the March to the May, we're catching up, but that's because we increasingly had more optimistic forecasts about the economy that you guys delivered. The last thing I just wanted to deliver, if you actually put the actual economic indicators, which nobody knew, but in the end, and you just put it back, our model was very close. It was 29.5% versus 29.1%. So it just goes to show you that the Model 1 is actually a pretty accurate model. If you can figure out what the indicators are, is a relatively accurate model. So, and it's just another reminder for you guys to we really value the amount of time that you guys take to put into your surveys and put the economic models, because they really do make a difference. And I'll just end it with this, which is kind of like this normal range that we've been trying to put in. This is with the constitutional refund, right? So we've already taken out that $336 million from the final thing. But for example, if you guys thought that TPI was going to be 2%, and this is all coming exactly from the model, and you believe that visitor arrivals would be around 9,500, right? Like 4.2% would be a very good guess with the for revenues this year, right? So that incorporates the impact of the constitutional refund. Does anybody have questions about that?
Yeah, you're using the total visitor arrivals only as to compare, but when we're doing our forecast, it's with all these variables, not only just one. Is there a reason why you're showing just a correlation between state visitor arrival and the rest?
Because actually there's our model actually really runs like I think 95% of the power of our model comes from total personal income, visitor arrivals, and construction spending. Right. And we look at visitor arrivals and TPI because those are a little bit more variable than construction. We could also include construction spending in there too, if that was something that was really important to you guys. But those three variables are most like produce most of the power of model one.
Seth, can I clarify something that
Mhm.
you mentioned? So you said that the impact of the constitutional refund is solely for the current year, but would it have an impact on future years? Because when we're, basically it's a growth forecast, right? So we're starting from a lower spot, right? If we adjust down, so that in theory would have some impact, right, to future years.
That's a great observation. So if we go back here, this is why this is with the constitutional refund. This is why we're lower here on this year. But in fiscal year 2024, we go up to 9%, because basically that's because of the base effect that
Okay.
you are alluding to.
Do you happen to know what the criteria would be that they would have to do the refund? Or was that amount pretty judgmental? I mean,
That was a decision by the governor to give that type of tax refund. So nobody's counting on it to be the same exact thing next year. And there's no existing formula for another constitutional refund.
okay, but they actually could decide to give another refund next year too.
But Marilyn,
Yeah,
this
but the
is it.
the legislature can also decide to refund $500 million or $0. Like it's at the discretion of the legislature.
And they could decide to raise taxes by 100%.
Yeah,
But
yeah,
we're not. It doesn't help. We're not going to be taking into account future tax decisions before they're ever made and voted on, or the governor makes the decision.
Okay.
Okay.
And just before, or at one point, I'd like to introduce the new director as well.
Oh, we can
But
do that now.
You want to do that
Thank you.
now, or you want to do it
Yeah,
after
yeah,
we make the
yeah.
decision?
But
Okay.
thank you, Dr. Kobe. That was very helpful.
Yeah.
Now, please go ahead.
Can you hear me?
Yes.
Yes.
Hey, hi, good afternoon, council members. My name is Gary Sugunuma, and I've been the director here at the Department of Taxation for about a month now. And, I'm still kind of getting my bearings, and I'm learning a whole lot. I previously served as a Deputy Attorney General for the Attorney General's Tax and Charities Division. That was immediately prior to this appointment. It's a real pleasure to be here and to see all of you. I look forward to joining the meetings and learning a whole lot from you folks. And please know that the department stands ready to support you and the very important work that you do. And so thank you for your service.
Thank you.
Thank you,
Thank you.
Director.
And welcome.
Nice to meet
And
you.
all- Yeah,
Yep.
nice to meet
We'll see
you.
if
All
he
the
says
best
that
of
at the
luck.
end of the meeting.
Okay. Thank you, Director. Appreciate all the support and help, and the Kobe and his staff. They've been very supportive. Thank you. Okay, next item on the agenda will be discussion and vote on the general fund tax revenue forecast for fiscal year 2023. Normally start off with Dr. Bonham.
Oh, we do? So actually, I think following up on what Seth presented is useful, because it was just a single data point, right? It was last fiscal year. but it gave an example actually of the council playing catch up through the whole fiscal year in a very turbulent and uncertain time. And then it gave an example of if we had gotten our input forecasts correct, then Model 1 would have given us essentially the right forecast. And so we've got Model 1 to play with again. And I was kind of struck by the fact that the council's inputs from meeting to meeting. So I'm looking at table 1 in the core booklet on page 1, and the input forecast that the council provided, I'm assuming, has gotten stronger, because the forecast from Model 1 is without the constitutional refunds. There's more going on that's not quite this simple, but the forecast without the constitutional refunds is now 9.4% from Model 1 for fiscal 23. Now, I don't remember what it was in the last meeting, but the council adopted a forecast of 6.5%. I'm interpreting this as council members raised their forecasts. I could be wrong. It could be we pulled them down because nobody believed 9.4% at the last meeting. But I always kind of like to start with the council mean forecast. I think that's an important place. So I would encourage us to think a little bit about whether the inputs to the model are really what we believe. And I guess I would highlight a few where that I suspect are off. One, I think our visitor forecast for this year is probably too weak by several percentage points, which we know from Seth matters quite a bit. I think our visitor expenditure forecast is also similarly too weak. And then going forward, I guess I would argue that our construction forecast is entirely too weak. And I'm talking about table 3, which is the forecast of key economic indicators, the average for the council, where we have construction completed growing at roughly 6% for the next 2 to 3 years. And I think we're going to be surprised by how strong construction spending is for the next 2 or 3 years, like almost double that in 2024 and 2025. Having said all that, I actually kind of still like the forecast we released last time.
So are you talking about fiscal 2023, or all the
Yes,
years?
yeah, we're only doing one fiscal year at a time, right?
So you like just to be clear, you like the 6.5% estimate?
Yeah, that's right.
Well,
I mean,
it-
I suspect that we worked off of a pretty high number in our last meeting, and we pulled the number down from Model 1. I guess I could go back and look at the booklet from last meeting, but I guess I have a hard time with a 9.4% forecast. I think that to me, that's of course that's 9.4 without the constitutional constitutional refunds. It's 5.8.
Yeah.
I think that's still a little bit on the high side. And Seth provided us with a general fund calculator, and he was kind enough to plug in the 6.5% number for the rest of this fiscal year. So this is the spreadsheet that came over in the email along with the PowerPoint. And so that 6.5% number that he plugged in for January, February, March, April, May, and June is just our last forecast. And so if you were comfortable with that, and in my view, the outlook hasn't changed markedly over the last since our September meeting. If anything, it's probably gotten weaker for next year, but I don't think for this fiscal year it's really changed that much. And so if you plug that 6.5% number in for the rest of the fiscal year, you get 4.5%. And so that's the sense in which I think I feel a little more comfortable with a number closer to our previous forecast, or the Model 1 with constitutional refunds at 5.8%. Hopefully I didn't confuse everybody with my rambling.
And this is Marilyn. Can I make a comment? I guess I've been reading a lot of other articles about a lot of economists expecting a recession in the next year in 2023. There's been a lot of firms that are laying off people, and the feds now seem to indicate that they're still on the path of raising interest rates. The second thing is with respect to the Japanese visitors that we're talking about. I actually went to Japan in November, and as soon as they opened the I guess eliminated the requirement for visas. And Japan, the economy there, the tourism there is not like what it was before the pandemic. A lot of the entertainment facilities, restaurants have closed. The yen exchange rate still, although it is higher than what it was, it's still standing about at 132 yen per $1 US. And with that ratio compared to the pre-pandemic value of the yen at 108 to $1 US would make a lot of Japanese tourists, I guess, more hesitant to come here to spend money. So both the economy there, to me, when I've looked at all these entertainment restaurant facilities and what's happening there, it's not as robust because they don't have the Chinese tourists going to Japan. I guess now they have opened it up, but it's still going to be a slow going for the Japanese visitor, I think, to come back to Hawaii, just because of the costs. Not only the cost, they didn't have very much inflation there. You know, it was not very much, maybe up to 3%. So when they compare that to our inflation rates here and the prices that have gone up here, they'll probably have sticker shock. That's just my opinion on that.
So if I can, so my comment about the our internal forecast is, in my view, things haven't changed very much. So everything that Marilyn said, we knew that in September. I mean, there have been very minor changes. Nobody expected that the Fed was done raising interest rates in September. I mean, maybe somebody did. Every once in a while, the bond market thinks that's what's going to happen, and they're wrong every 3 months. They're proven wrong. But I don't really see. I mean, so our forecast from September for Japanese arrivals was too strong, but our forecast for U.S. arrivals was too weak, and that's been the story for the last year. The U.S. arrivals keep surprising to the upside. So I guess what I'm trying to say is that the last forecast we released still looks pretty reasonable to me.
Yeah.
I don't see a lot of reasons to change it. And we've been forecasting a recession for the U.S. economy since our September forecast. So I don't really find that to be what's happened is more economists and more businesses are taking that view, but we're all going to be wrong. And it may not happen in 2023. It might be 2024. That's what the Fed staffers are telling the board, is that they think that the recession won't happen until 2024, and that it'll be a very modest recession.
I guess one thing that's concerning from what I'm seeing businesses here is that a lot of them do not have employees. And so, the restaurants are closing down early or cutting back in hours. Businesses are the same thing. And everybody says, pardon the inconvenience, because of staffing. I think ultimately the lack of staffing is going to impact the profitability of these businesses, the small businesses. And eventually you're going to see some, I think, close. But, that's just my opinion. This is just widespread around town. And I'm not sure how it is in Honolulu with the staffing problems, but here it's pretty severe.
So just to follow on a theme, we talked about that last time too.
Right.
It hasn't changed. It's really, if anything, things have gotten better. If you look at the labor force data, labor force is back to within 1.5% of where it was pre-pandemic, and job counts rose very sharply throughout the summer. And so, yeah, businesses are struggling to find workers. I think it's a lot of that is matching problem. So the workers who used to work in the restaurants and the hotels who moved back to the mainland aren't here anymore. And the people who are here don't want to work in those establishments. So it's kind of a matching problem that will take time to work its way out. I mean, your point is valid. It has an impact on the economy. It's hard to make money when you can't open your doors.
Right.
But I guess I would suggest it's not nearly as bad as the casual empiricism would suggest. The hard data suggests that it's the shortage of workers, just in terms of aggregate numbers, is no worse than it was in 2019 before the pandemic.
Yeah,
We
I
have
know that's hard to believe, but that's what the data says.
the job count though is still down 40,000.
Well, that's if you don't revise the data. The revised data is down maybe 30. I think our estimate is 31,000. So job counts are down because people haven't gotten their second jobs back because they either don't want them or, or the people who are holding 2 jobs moved to the mainland, and the people who are still here are holding 1 job, right? If you look at the employment numbers, so the household survey, which only counts each person once, that number is, I think it's maybe 14,000 down. It's about 2.5% down from where it was pre-pandemic. It won't help you to go look at DBED's website because it's different data, right?
Yeah.
So we're revising the data on the fly, and we don't even publish it on our website. We really should. And there's a big difference. This revision we think is going to be quite large. So it's the payroll jobs are still down about 5.5%, but household employment is only down about 2.5%.
well, I think what I see here too is people are wanting to work less hours, whereas they wanted full-time, they want to go part-time now. And a lot of people have been sick for flus and whatever, but people have been sick. And so we haven't had the workforce that I think is necessary to have a robust economy, just temporary. Hopefully it's just temporary, but that's what I see here. I mean, it's not only just restaurants and hotels. I see that for professionals, dentists and whatever, they're all readjusting their hours and reducing hours that they're offering.
So, there's another thing that I think really gets missed. We keep talking about, tourism being in recovery mode, but the fact of the matter is tourism spending is above where it was pre-pandemic, even after adjusting for inflation. So in real dollars through November, in November, at the end of the year, the latest data we have, it's higher than the highest point it was right before the pandemic. So in real dollars, we've completely recovered. Doesn't matter how many, you don't want all the visitors back anyway, right? So if we could stay at 4 or 5 or 6% fewer visitors and they spend more money, that's great. And we're doing that even with the existing labor force issues.
And I think with inflation, prices are not going to go back down. So collections will remain high. Property tax valuations are high. If you live in the Kaka'ako area like I do, there is going to be 3 or 4 more towers going up that's already being sold. And to get into one of these new towers, you got to jump in early because they're selling out like hotcakes. And so to me, the 6.5 I always felt was low. I do think the way Hawaii has a reverse relationship with the mainland. When pricing is high here, sales tax increases, property valuations go up, that increases. Construction is very strong. We got big projects, not only from the private side, but the public sector side that's going to hit. And so there's a lot of positives. And I think the last time we were looking at this, we were concerned about the effects of the Ukraine war. And we thought, oh my God, that was going to, pile us to the ground, but it hasn't. And and I remain optimistic.
Yeah, that still hasn't been resolved yet, the Ukraine situation.
Right, but we don't know. We know
No,
what we know. And, you know, at some points it got to resolve itself, but it hasn't had a substantial impact to us yet.
Yeah, and put this in context, oil prices are back down below where they were before the war started.
Yeah.
And so, yeah, that's, like I said, I don't really feel like the outlook has changed very much. I mean, there are downside risks for sure. The US recession is a real risk, but what keeps happening is the US economy just continually surprises to the upside. It continues to be stronger than people are expecting, right? We continue to add jobs. I mean, you see all the news about all the tech layoffs, but the job openings in tech are way larger than the layoffs, and overall job growth continues to be very strong. So it'll flip when it finally changes. It may change quickly, but right now the U.S. outlook is. So to put in perspective, it won't surprise me if when we release our first quarter forecast, we're saying, oh well, we're pushing that recession back another quarter.
To what extent is this surprising strength in the economy a function of the amount of money that was poured into the economy by the COVID fiscal stimulus and money supply increases and so forth? Because checking account balances just skyrocketed.
Yeah,
and so that creates a cushion that a lot of people are drawing on, I suspect, and that's one of the reasons why consumption remains high, even though incomes might be a little squirrely.
So if I remember correctly, the estimates of the excess savings that accumulated during the pandemic reached, I want to say 2.6 trillion.
Yeah, I was going to say between 3 and 4 trillion.
And the last estimate, so the Federal Reserve has been doing estimates. Unfortunately, the raw data for doing these calculations, they changed the methodology on some of it, so it's not as clean. But yeah, so people have been spending that down for sure. And if I remember correctly, the last number I saw was that there was still about 1.7 trillion in excess savings. And the bulk of that was for people in the middle and upper end of the income distribution. Not, the people in the lower end of the income distribution have spent a lot of that money already. And so that's one of the things that optimists keep pointing to, is look at all that savings out there. I point to it and say, well, a lot of that, particularly in the upper end of the income distribution, it's not excess savings, it's wealth that they didn't have any place to put it except a money market account, because they knew bonds were going to tank. The stock market was already tanking, so it's really wealth that people are sitting on. Granted, it's there if they lose their job, so it still provides that cushion. But it's really important, right? Because the thing that's going to determine whether the U.S. economy goes into recession is consumption, right? I mean, we're already in a manufacturing recession, we're already in a housing recession, and the thing that's holding it all together is job growth and consumption, even in the face of high single-digit inflation.
I guess I read somewhere that there was a lot of borrowing starting to go on now, that people are using credit cards. Is that right, Christy?
So the problem is you
That
can't
is-
tell whether, so for example, I mean, many of us use our credit cards for day-to-day purchases. I don't carry cash, I don't carry a debit card. And so if prices are going up at 10%, then your credit card balances should be going up at 10% if you use it for day-to-day transactions. So we looked at this, and my recollection was that it looked like you could explain most of the increase in revolving debt as being associated with inflation.
I have a question.
I mean, that's a problem in this, to the extent that wages aren't going up as fast as inflation.
I have a question for, procedurally and in terms of our forecasting. Are we going to just make a forecast that's with the adjust or without? Oh, shoot, how to phrase this.
It has to be with,
With the refund taken out, or are we just gonna assume that the refund didn't occur and then subtract that with the back end? In terms of our
Oh,
forecast?
yeah. Are we doing a
I think we
below
got
the
to-
line and above the
Yeah,
line
Don't we
number?
do a
And
net?
My suggestion would be that we just ignore the refund and, you know, and then back it out. In terms of creating a forecast.
But we're required to give a net, right?
Well, yeah,
But
no, I
you're
understand,
talking
that,
about
but in
process.
terms of the
The
steps
process.
that we take to make a forecast. Do we zoom in on the after refund number? Or do we look at the underlying number and then make a forecast for that? For internally, for our deliberations, and then subtract out the 300 some million.
so the way that, I mean, the way that I was starting to approach this was, as I've said too many times already, I don't think the world has changed that much since our last meeting. So if we were comfortable with 6.5, ignoring the refunds last time, then we'd probably ought to be comfortable with that for the rest of the fiscal year. In other
Mhm.
words, pick the growth rate for the rest of the fiscal year, essentially ignoring the refunds. Plug it into the calculator and you get what you get. And so,
Right.
you know, Wendell thought 6.5 was too low. So if he wanted to go 7.5, he plugs it in the calculator and, you know, he'll get a number that's closer to our old 6.5% forecast. So
So,
I guess I'm saying, ignore the tax
Well,
refund
but
for the moment.
the
Think about what your underlying
the-
growth rate is.
But the calculator has the 308 million already subtracted out, doesn't it?
correct,
Yeah.
We're
Looking-
picking
I
the
mean-
growth
Just
rate
almost all of it,
for the
yeah.
rest of the year.
yeah.
No, I understand. Yeah, I understand, but in terms of the final number, what you assume, if you assume 7% or 6.5% for the rest of the year, it comes out as 4.5%.
Right,
Yep.
That's because we subtracted the refund. the
Because we have to
constitutional refund.
when we submit the final number.
Right, and so if you don't subtract what is it, you know, if you assume 6.5% for the rest of the year and don't subtract the constitutional refund, what's the bottom line we get?
it's more like 10%, yeah.
I think it's kind of in a 9.5% range or so. I mean,
Yeah, that's what I wanted to clarify with you, Carl, when
Yeah.
you said, I think things are the same. The big thing that isn't the same is the 334 million or whatever it is.
No,
So,
I understand
yeah.
that. I mean, what I mean is that if the underlying economy that we
Mhm.
talked about in September is not that different right now, and if we came up with a 6.5%, then effectively you could have argued, well, we were going to get that every month,
Mhm,
right?
yeah,
And so that was a kind of a good starting point. And
right.
then you plug you plug your number into the calculator and it tells you what happens after the refunds.
Yeah, I was just trying to clarify what you meant,
Yeah.
and I think that makes sense. One
It's
thing
kind of
that
this,
Go ahead.
it's kind of the same thing that I did in my internal forecasting is basically pull the refund out and then almost put it back in to get your first quarter 2023 number, and then the growth rate stays the same for the rest of 2023, and that's how you get. So in other words, you're not changing the underlying trajectory of tax revenues. You're just yanking it down in one quarter and then bringing it right back to the previous path, right? So if you looked at a graph and you have a upward sloping line, you just have a V shape right in that fourth quarter.
Mhm.
So now if we started out last year for the fiscal year 2023, and we had 6.5 and you subtract out the 3.6, you end up with a 2.9% growth rate, or am I reading this wrong?
That would be correct as far as the math goes.
So if you just use what we had, 6.5, and you subtract out the 3.6, which is the estimated refund, then you end up with a 2.9% growth rate.
Mhm.
Didn't we know?
Yeah,
there was
so the
gonna be a
problem is that
constitutional refund?
we didn't really start at 6.5. 6.5 was our forecast for the whole year. The problem
that's
was at the start of the fiscal year, the growth rates were much, much higher.
Yeah,
For the fiscal year 223, I
Yeah.
think it was 6.5, and then if you subtract out the 3.6 that we were given, then it ends up being a 2.9.
so what Carl is doing is saying 6.5 for the rest of the year. So starting from such a,
January.
with the spreadsheet that Seth provided, which is very helpful. If we put 6.5 going forward, we would get to 4.5, even considering the refunds that went out.
And if you didn't consider the refund, you'd add 3.6 to that 4.5,
Yeah,
8.1.
so we had very strong, except for the taxes that on individuals, the refunds, we had very strong collections year to date. One thing that I do that is really early to say what it really means, but one concern that I have is just the weakness in visitor arrivals on the last half of December. I love that they have daily numbers, but it looked like things really slowed down in December. So that is one concern that I have. I don't know how things will be going forward, of course, but that is a concern.
Was the slowdown attributed, does anybody know
Yeah.
whether or not that was attributed to, the weather issues that they had towards, I guess around Christmas? Because I know talking with some people, they said that there were visitors that couldn't even get here. If they were on the East Coast and having connecting flights, they couldn't get to the West Coast and then get here. So I know that they either they ended up getting delayed or they just canceled their trip. But on the flip side, I guess I had heard that there were some people on the West Coast that had trips going east or other places, and they couldn't get there, but they could get to Hawaii. So they were taking those trips. So I don't know if they offset each other, and I don't know if we have that kind of data, Carl. I don't know if you've been tracking any of that.
Yeah,
Yeah, I mean, the daily
slowdown
passenger.
happened before the bad weather. So
Yeah, it happened before, because when we went to the Kealani for our Christmas party, they offered us really discounted rates because they said their hotel wasn't full, right before Christmas. And
The bookings for the month of December, as of Christmas. So, by Christmas, you pretty much have everybody, and these are on the books. This is even if they haven't arrived yet. We're lower than last year.
Yeah.
So about 6% lower. And the stuff that they've got on the books for January, February, and March are all higher. So probably an average for the first quarter of about 5% higher. And so I agree. I mentioned this to Eugene the other day when we were doing a presentation that the December numbers look pretty lousy. And yeah.
yeah, so December was lousy.
But
And-
when you call it lousy, we're still US visitors are still very near record high levels, right? They're still way above where they were pre-pandemic. And so, yeah, it just wasn't continuing to grow over an extremely strong fourth quarter last year or December last year.
Yeah, I think, for example, on Maui, I think the occupancy rate is very low, but the room rates are high. They still have high room rates, and I'm not sure whether they can keep those room rates up, to be over 1,200 a night or something.
Well, I know one thing: the hoteliers will all tell you that they can't lower their rates.
What?
I said, I guarantee you, the hoteliers will tell you they can't lower their rates. That's and then if things get bad enough, they will. So that's one of the things about where we are right now is rates have gone up so much. Of course, their costs have gone up as well, right? Their labor costs have certainly gone up, and their electricity costs, all their input costs. But there's room for discounting to try and maintain the kinds of occupancy rates that they'd like to have. But if you look at occupancy rates statewide in November, they were 75%. On Maui in November, it was 64%.
It's,
Yeah, and average daily room rates of over $600.
I don't,
Right.
who are these people who can afford that?
yeah, it's very
Yeah.
expensive here.
Yeah, sleep in my car. I think.
So anyway, that's the question. I keep worrying about the fact that there are alternative vacation destinations that have lower rates, that people would be attracted to going to other locations versus Hawaii, because we might have priced ourselves out of serious contention as a vacation destination.
Well, so I mean,
Yeah.
the
Malcolm.
fourth quarter of 2019, the occupancy rate on Maui was 79%. And in the third quarter of 2022, it was 70%. But the revenue per available room is now $433 instead of $318. So they're making up for their losses during the pandemic. And you look at the TAT revenues that Seth was showing us, and the excise tax revenues. As I said, total visitor spending is above where it was pre-pandemic in real dollars.
With fewer visitors.
Yeah, with fewer people.
So we're getting exactly what we want.
Yeah, so we're getting more people willing to pay more and less visitors here, actually.
And staying a little bit longer still.
Yeah, so, and maybe that's what's going to happen with all the businesses here that are short of employees. They'll have to just raise their rates for their services or for their whatever offerings they have, and then they'll just, less people will be buying, but they'll still keep the same revenue. And it's
Work less for more money.
yeah, work less for more money.
There we
Good.
go.
Yeah. And so in that way, the inflation will keep up our revenues. But it's, to me, it's taxes on inflation. And that's where we're making money on.
So does anybody want to make a proposal that, or is it all going to be on me?
Yeah, well, do we want to go with the 4.5 after the adjustment, which would be 6.5 for the rest of the year? And then adjusting for their refund?
That's for 6.5 the
No,
rest of the year.
that is with the refund. Is 4.5% is with the refund taken into consideration.
Correct.
Correct.
So if we didn't take the refund into consideration, we'd add 3.6% or so,
Right. Mm-hmm.
which would
And-
put us slightly north of 8.
Right.
And right now we have, I guess our actual is 2.9.
You know, I actually like Model 1 on Table 1, 5.8 better than the 4.5.
I think the 4.5 might be better because we'd have to go from 2.1 all the way up to 4.5.
Well, yeah, but you're not going to have 300 million coming out in the next, in the rest of the fiscal year.
Yeah, but we just said we're going at 6.5. I second Christie's motion.
I didn't hear a motion yet. Oh, did
I'll
Christie,
make
did you
that
make it?
motion.
Okay.
I'll make that motion.
Motion and I'll second it at 4.5.
So you think it's gonna come in stronger than the 6.5, Carl? That's-
Well, Model 1 does.
I think
Let's see
we're looking at the
what my
recession.
forecast was.
Mine comes in at 6.3% with the constitutional refund.
Really?
Yeah. That's what my model says.
So
What do you
that,
think, Councilmember Hayashi?
No, I mean, I think the 4.5 seems low to me. I would agree that I think it's probably going to be higher. I mean, based upon where we were at 8.4 last time. That was the mean forecast. We adjusted it down to 6.5, and that's not considering the constitutional refund. Now, you know, I would agree that I think based upon what I'm seeing, I mean, things have rebounded. I mean, things are rebounding, and things I think are stronger than what we had initially anticipated, even back in September. So that's why I think the 4.5 to me seems low. I would agree. I think it's closer to 5 to 5.8. And just plugging in the the numbers into the CES model. I think if you assume that there's going to be growth of about 8% for each of the remaining 5 months, I mean, you get to about 5.2. So,
You're
you know,
looking at somewhere in between the 6.5 and the 4.5, 5.2 or 5 to somewhere in between.
yeah, well, just looking at it, I mean, I think Carl was suggesting that our current mean forecast with the constitutional refund is at 5.8. That seems fine to me. I mean, I think that I wouldn't be opposed to that. That might be a little bit higher than you know, basically what I was thinking, but you know, between 5 and 5.8, I think that's to me, that I think that's where we are. That's where our forecast would lend itself to be.
And that
So I
makes
think
sense because that's what we all independently put in the model, the 5.8, and then we always talk ourselves down, and then
Yeah.
we're low in the next quarter. So maybe we should just try to go for what the numbers say.
We've actually been high in the past too.
Yeah, we're not
Yeah.
always.
It's been a
low.
while.
Yeah,
Well, since I've been on, we've been low.
yeah, you've been on
You-
during
you've
a
been
very
lucky.
growth period. The revenue has been very robust, but I remember once when Marilyn dropped it, when she was the vice chair of the meeting, dropped it to
Yeah.
0.4, and I think it ended up in, it was negative 0.4.
It was,
It
it
didn't-
went
negative
negative
one.
after it went positive. Yes,
It went negative, it went further negative in that
Yeah.
year. So what about splitting the difference, 5.5?
I could live
Five
with
and a
that.
half is basically what you get if you think revenues are going to grow about 8% for the rest of the year. And what I think what Scott was referring to earlier was that our council mean Model 1 forecast for fiscal 23 at our last meeting was 8.4. And so we talked ourselves down to 6.5. We adopted a lower number. And so I guess I would be comfortable going with a 5.5 for fiscal 23.
Me too.
We'd be talking ourselves down again.
What
Just
about
not as much.
Councilmember Lee? Are you,
you know, I recall that there was we had a chart that showed that we had a lot of income coming through in the second half of the year. Seth, was there something that you showed us?
Yeah, I mean, basically, like we get about 55% of our revenue in the second half of the year and 45 in the first half, and that's because of the large payments in April.
and
So
also Christmas, right? Christmas season too.
Christmas season is next month, January, is usually our second largest income month, and April is our largest. And so, you know, one of the considerations that you have to think about is like, you know, we've had some large payments in April in the last 2 years, and are we going to keep that up? Is it going to be the same? Is it going to be less? We don't know. The declared estimated taxes does give me pause, and like that dropped, right? So
Right.
some people think they're going to owe less taxes, but either they're wrong and they'll have to pay more in April. I don't know what's going on, but so that's just kind of like the one question mark, right?
Thanks for bringing that up, Marilyn. We had a record high
Yes.
collection
Yeah.
I
last
just want to
April.
remind you,
Yeah,
the
Was
past,
that
we
about
had
1
those
billion in a month?
funds
1
coming
billion?
through and all that, so we
We
had a
can't
lot.
all talk at the same time.
Yeah, we had a lot of income taxes coming through in April and May, I guess. We'll have to get through that hurdle of having a lot more income at a time when we think that there might be upcoming recession. Some people are selling things still, but
I mean, the income is for everything that's going to happen in April and May for the income happened last
Already
year.
happened.
Right,
Yeah.
because you're reporting on that, so it's not really a forward look. You don't have to worry about like what the future economic things is going to do in terms of impacts. What you have to worry about is what do you think happened to income this year?
right. Well, one thing we do know is that there are going to be lower capital gains for anybody who had to sell stock. Or fewer people
Well-
willing to sell, right?
yeah,
You don't necessarily know that. I mean,
I don't think
because the
so.
market's down doesn't mean your capital gains on what you sold is down.
Well, the sales are down,
You mean people are selling less of their portfolio?
correct?
Yeah, Marilyn, you would probably see that with your practice, yeah.
Yeah, there was a lot
On the other
before.
hand, home transactions last year would have been, in terms of dollar volumes, would have been extremely high, just because of where prices were.
Councilmember Lee, do you have any comments about the 5.5?
I'm good with that. I mean, the numbers before that were just too low, I thought. I would like to be higher, but you know, compromising is okay. We'll see what happens next time.
Anyone want to make a motion?
Well, we have a motion already on the table, I think.
That was at what? It's
Four-
4.5, right?
Yeah.
Christie, you want to go forward with that? don't
I
know if
will
it has-
amend to 5.5.
Okay, and then do we have a second?
I guess that was me who had seconded her motion.
Okay, so the vote,
Okay, I'll amend my motion 5.5.
okay, so the motion on the table is 5.5 growth rate. That's net, that's after the constitutional refund,
Right.
5.5% for fiscal 2023. Vice Chair,
Yes,
Dr. Siderout? Dr. Jack, Dr. Siderout?
You're muted, Jack.
well, we can't hear you.
I know, I was muted. Sorry. Yes,
So, okay, yes. Dr. Bonham,
Yes,
Councilmember Maynard,
Yes,
Councilmember Hayashi,
Yes.
Councilmember Lee.
Yes.
Okay, so the vote carries unanimously. Okay. Thank you, council members. So the next item on the agenda is the next fiscal year 2024. Anyone want to start us off?
and now math comes into play again. Yeah,
Yeah,
yeah.
I've been playing
Well-
around with it, just to give you some, I've been playing around with the calculator in order to get the same dollar value that you had estimated in September would be 8.5% growth. About.
And part of that is made
Or I'm
possible by
sorry,
the
maybe
fact
it's
that
9.
no, that's not right, Seth.
You don't, what do you see?
I mean, I just plugged in 4% across the board and I got 10,248,557,000, and we were at 10. Well, maybe you might be right. I don't. Oh, I'm sorry. Never mind. Ignore me.
Because the previous, our previous estimate was for 10.4 billion. And so,
Oh, I'm
And-
looking at the current.
Oh,
forecast
no,
is
like,
only
yeah,
10.36.
yeah, because
Yeah.
it'll be bigger, right? Because you have to basically add 300 million to that.
No,
Or you're adding $300 million.
I'm talking about the top line in table
Okay.
1. That's
Okay.
already got the refund, right? Are you trying to back the refund out?
Yeah, to figure out how you guys can get. Well,
mean,
either way, like, or you can just use what it is, which is 9.6%, right? If you guys follow your models. So I'll be quiet.
Once again, I actually like the current forecast from September. Although I would boost fiscal 24 probably by 1 percentage point. I mean, there's more than one thing going on. It's not just a year over year bounce because of presumably no more tax refunds, but it's also what's happening in the underlying economy. And we did lower our US forecast a little bit in all of 2023, and it's been moved back so that more of it would show up in in fiscal 2024 instead of fiscal 2023.
When you said it's been moved by Dr. Bonham, are you talking about a possible recession?
Yeah. I mean, 4 months ago or through whenever we released I think we released our forecast in September. Our forecast was for a recession starting in Q1, and now it doesn't start till Q2, and it goes through Q3. And
2024.
like I said earlier, we're going to be wrong. No one's going to get the timing right. So,
What year are you
I'm
talking about?
just expressing some concern about growth prospects in the second half of 2023 and into 2024.
Which you're talking calendar year, Carl?
Yeah. So it would mostly be a fiscal 24. So what I'm getting at is that we're dealing with multiple things. One, there's going to be a bounce in the growth rate just because we had a $300 million lower base in current fiscal year. But then on the other hand, the economy may weaken some in the next fiscal year.
Mhm.
So I'll make a motion. I'll move that we adopt 5% in fiscal 24 and leave the remaining fiscal years unchanged.
Well,
I'll
you're gonna
second
take
that.
on all the years?
I did it all at once.
3.5.
Because Carl, based upon updating Seth's model, that 5% gets us back to, I guess, what we forecasted to your point of 10.3 billion, basically for back in September for 2024, correct?
Let me see.
Yeah, 10.2.
Yeah, it gets us. So what
Pretty
did we
close.
forecast in September?
10 billion,
It's 10.365. Yeah.
Yeah.
Yeah, it gets us to 10.347 or something like that.
Yeah.
See, I told you I liked our old forecast.
Christy, I'm just curious, how are long-term interest rates behaving? How's the financial markets looking out with regard to, I guess, inflation and everything else?
Well, the futures market is anticipating that Fed funds continues to go up until mid-year and then start coming down again. So the futures market is showing. The forward yield curve also is showing that expectation of rates decreasing. What's very concerning to me is the inverted yield curve. The 10-2 spread is about the worst I've seen it in a very, very, very long time, and that has a very good predictor of a recession. We're not sure about the timing. Usually it's 12 to 18 months forward, but it's been inverted for quite some time. So that's what's most concerning to me. As Carl said, the markets keep predicting that the Fed is going to stop, and the markets are wrong. But the Fed's own projections have been wrong also. So whatever they've projected earlier in their year, they've changed since then. So,
But so far,
I don't believe any of them. But the markets actually, you've got people putting billions of dollars at risk to bet on things going a certain way. So that's a little bit. They've got skin in the game, as opposed to an economist who comes up with an opinion. Yeah.
No
The,
All
offense.
right, no offense. No offense.
That's what
You
they're
mean
saying in the
we.
boardroom.
but the forecast errors have all been under forecasting, both the
Yeah.
Fed and the
Yeah.
markets. Of course, they under forecast inflation as well, right? So
Right.
the Fed kept saying, we're only going to have to raise rates this much. And the market said, oh, you're not even going to raise them that much. And then the Fed came back and said, we're going to raise them more. And the market said, oh, you're not really going to raise them that much. And we're still in that game, right? And actually in the last couple of days, the markets has taken a little bit of a shock because the Fed governors have been out talking about 5.5 as a terminal rate.
Mhm.
And the market was more like 5.2 as a terminal rate. And I mean, all along, this economist and our team has been arguing higher for longer, which is the Fed's mantra of late. In other words, inflation is going to be more persistent than people expect. So if you believe the bond market right now, which means rates start going down by May, right, and they shave 25 basis points at least off by the end of the year, either inflation has to fall pretty rapidly, and wages too. Wage growth has to come down pretty rapidly, or you have to get a recession, or both, right, or some combination of those two. And interesting note, Christy, is I saw a piece, an article, I can't remember where it was, maybe it was Forbes, but it was interviewing Andrew Harvey, who invented the yield curve as a predictor for recessions. And he's arguing right now that it's probably not working right now. And because what's that?
This time it's different.
Well, that's kind of what you have to argue in order to say we're not going to have a recession, right? Because both the 10-2 and the 10-3 and now the 10 Fed funds rate are all negative, and they're more negative than they've been since the late 80s. And the models that we run using yield spreads are telling us 75 to 80% probability over the next 12 months. There are certainly people who are arguing that this time is different. And if there is a time that's different, it would make sense that this is it because of the pandemic and because of all that money that flowed into the economy through the stimulus and the way the Fed is monkeying with the bond market, right? So getting rid of quantitative reversing, or whatever we call it now.
Carl, do you actually think that we'll go back to, the inflation will drop that much? It was 7%.
Absolutely. It's already falling rapidly. And people don't even realize how fast it's falling in Hawaii, for example.
Okay.
I mean, used car prices have been falling for 6 months now. And we're going to see the impact of falling rents in the next 3 to 5 months. That's going to start to act as a serious drag. We're already seeing the decline, particularly nationally, huge decline in gasoline prices and oil prices, not so much in Hawaii. And so I think in our last forecast, year over year by the fourth quarter, so Q4 2023 versus Q4 2022, I think our inflation for Hawaii is 3.3%.
3.3?
Yeah. And I don't know what the Fed is for what their forecast is. That's the way they do their forecast too, is Q4. But for the Fed, even if inflation were down to 3 or 3.5 or 4, they're going to be watching core, and they're going to be worried about wage growth and services inflation. So the headline number can fall a lot, but the underlying inflation can still be high because all these transitory effects from oil and used cars and basically goods inflation is declining. And we're going to get disinflation for goods because we went through the opposite effect during the pandemic. And what matters is what happens to services. That's really the key for the Fed for the next year is, do we see wage growth come down, right? You're talking more than 5% right now. It's going to have to come down pretty sharply to 3.5 or 4% before I think they take the foot off the gas pedal, or the brakes, I guess I should say.
Yeah, I guess I kind of wonder whether we'll still have taxes on this inflationary, cycle.
Well, I mean, we're not talking about prices falling,
down,
right? We're talking about inflation coming down. And the core, so if you look at the council's mean forecast for the CPI in 2024, it's 3.35%. 2025 is 2.6, 2.2. I think that's pretty reasonable.
Okay.
So I don't know if that has much of an impact on Model 1. It does on the model that I run. It's the CPI inflation is in that model and is pretty important.
Yeah, I think the big I've seen some pretty credible arguments that, of course, the Fed was very late to start raising rates. They waited over a
Yeah.
year with inflation above their target before they started. And they may have already overdone by continuing with this. So I've seen that argument too. They were late to start and now they should, call it a success and go home. However, back in, if you remember, Carl, I don't, but back in the 70s, they thought they had whipped inflation
Yeah.
once and then it came back again. So we don't want to have that situation either.
And in particular, the Fed doesn't want that to happen. They don't want to,
Right.
I mean, their credibility is tenuous at best. And that's their money where their mouths are, is they have to worry about their reputation. If they don't have that, then they have a really hard time fighting inflation.
Mhm.
But frankly, no one knows where things are going to be in a year.
So if we assume 5% for fiscal 24 and an inflation figure of around 3.5 to 4%. So we're talking about 1.5%, 1 to 1.5% growth rate.
Yeah,
Or
that's
1.5
not
or 1.5
that's not
to 2.
bad if you're, I mean, in our forecast, at least during the calendar year 2023, the economy just goes sideways, right? It starts to stall out. And so I mean, 1.5% real growth is not bad.
For fiscal 24.
Yeah.
Okay, I'll move 5% for fiscal 24. If that's
Well, I
not
think I
already
already
been
did
done.
that.
Oh, you did? Okay.
I will second
I made a
Carl's
motion of
Well, Carl did
5%,
all the years,
and
not just
then
24.
so I made a
Oh, that's
motion of 5% in fiscal 24, and then leave the remaining years unchanged.
I'll second that motion if it hasn't been seconded already.
Any further discussion? Marilyn, any discussion?
No. I'm fine with that.
Councilmember Hayashi, any comments, discussion?
Nope.
Councilmember Lee?
Nope, good to go.
Okay, take the vote at 5% for fiscal 2024. Vice Chair Nenwa,
Yes,
Dr. Siderhout,
Yes.
Dr. Bonham,
No. No, I'm sorry. Yes.
voting against your mo. Councilmember Maynard,
Yes,
Councilmember Hayashi,
Yes.
Councilmember Lee.
Yes.
Okay, so the vote for 5% for fiscal 2024 is unanimous. Okay, anyone want to make a suggestion for the out years? Beyond fiscal 2024?
I think Carl's.
That was in the motion.
included
That was in the motion.
Motion to leave it
I
the
thought we only
same.
voted on 1 year at that's what I said, when I repeated what we're voting on.
on his agenda.
But you can't vote on a motion that wasn't made. So
So do we have to vote on it again? Because
You
what
would
I
like to do
described
them
was,
separately?
well, we normally do the first year separately.
Yeah.
We don't, it's not necessary that we do every year one at a time.
yeah, I don't think so, but it might have been a misunderstanding. I just want to make sure we'll take another vote. This is just 1 year, fiscal 2024 at 5%. Great. Chair Nenwa?
Oh, well, hold on a second. Hold on. Sorry. But there was a motion that was seconded that covered the whole forecast horizon, I believe. Am I wrong about that, Christie?
What did you?
No,
what did
you are
you-
correct. That's my understanding. 5%
So-
Okay,
for
My
this year.
understanding was not that, so
Oh,
we
okay.
didn't have a meeting of the minds. Okay,
So
so
the out years was at what percent? Was that at,
3.5.
keep everything the same, but
beg your pardon?
so keep everything the same
That he was
beyond
gonna,
fiscal 2024.
we had,
So I'm trying to follow the agenda. So the agenda has 5%, well, the agenda is fiscal 2024.
Okay, we can
Okay.
redo it.
Okay. So do we have a motion for 5% for fiscal 2024?
Wait,
That was Carl.
that was Carl's.
I'll make that motion.
Okay, well, Carl did all the years. Okay, and second?
I'll second.
Okay, second. Okay, so this is fiscal 2024 growth rate of 5%. Vice Chair Nguyen,
Yes,
Dr. Siderhout,
Yes,
Dr. Bonham,
Yes,
Councilmember Maynard,
Yes,
okay, Councilmember Hayashi,
Yes.
Councilmember Lee.
Yes,
Okay, so fiscal 2024 growth rate of 5%, it's approved unanimously. Okay, all the other years, we need any discussion on that or we're ready to vote?
I think we voted once already, so I think
Okay.
assume we're
Yeah,
ready
but
now.
do we
It's
need
not what
another
I put
motion?
up to vote.
Yes, we do.
yes, we need a motion.
Okay, motion.
I move 3.5% for the out years.
Okay,
A
second,
second,
okay. See, 3.5 without years. So, we take a vote, it's 3.5% for the last 5 years, from fiscal year 2025 to 2029. Eastern Wall, 3.5% growth rate for each of the years.
okay, yes,
Dr. Siderhout,
Yes,
Dr. Bonham,
Yes,
Councilmember Maynard,
yes,
Councilmember Ayashi,
Yes.
Councilmember Lee.
yes,
Okay, so the vote, keep the growth rate at 3.5% for all of the years after fiscal 2024 at 3.5%. It's approved unanimously. The next item on the agenda is the Department of Budget and Finance, other revenues. Mr. Chen?
Good afternoon, Happy New Year, Chair and Council
Happy New
members.
Year.
My name is Donovan Chun and I am with the Department of Budget and Finance. We have provided you with our report and revised projections of general fund non-tax revenues, non-general fund tax and non-tax revenues since the September 6th meeting. The revenue estimates were prepared by departments in November and were based on point-in-time assumptions made by programs and department staff. Our report includes a summary of significant changes. I would like to highlight 2 areas with the more significant changes. Let me try and share this with you. On table 4A, special fund non-tax revenues, under non-revenue receipts, you'll see this item right here.
I'm not seeing your screen, Donna.
Oh, really? Let's see.
I do have the materials.
Are you screen sharing?
Yes, I am. I'm trying to. Let's see.
Seth, can he screen share?
Oh, hang on a second.
how's that?
Yeah, there we
Does
go.
that work? Okay.
That's Carla Sharon.
Oh, okay.
Okay. If you look at table 4A, there's under revenue transfers, non-revenue receipts,
Right.
there's a net increase in FY23, and that's primarily attributed to the transfer of 500 million in general funds to the Emergency Budget Reserve Fund, which is pursuant to Act 115, Session Laws of Hawaii 2022. And an additional 130.9 million in general funds to the Emergency Budget Reserve Fund, which is required by Section 328 L-3 of the Hawaii Revised Statutes and Section 6 of Article 7 of the Hawaii State Constitution. That area is similar to that tax refund. When certain targets are balances of the general fund, it triggers a transfer. So that was 500 million and an additional 130.9 million.
What is the trigger?
Yeah,
There's a it's based on the balances of the general fund for consecutive years.
Yeah.
And what's the money used for?
The
It's the rainy
emergency
day
budget
fund.
reserve is a
Rainy day
rainy day
fund.
fund. Yeah,
Oh,
so
it's
there's-
additional contribution to the rainy day fund.
yes. Normally the rainy day fund gets interest income, and then there's a transfer from the tobacco settlement, unless the legislature takes action to transfer funds. And this is part of it. 500 million was legislature transferred 500 million. And
So
then
that's
100
independent of the threshold, right?
Yes.
So they were paying back money they took out at the start of the pandemic, right?
Correct.
Oh, okay.
They're trying to restore that reserve.
Right.
And then the 130 was actually triggered, and there's a calculation for
So
that.
did they fully replenish the rainy day fund?
No,
From what
in
they
fact, I believe in this next session, there's a request to add an additional 500 million. We have not included that because it would take legislative action. So if and when that gets passed, if it does get passed, it would be an additional infusion.
Where's that
So
money parked?
It's parked in the in a separate account within the state investment pool. So right now, I believe there's approximately 600 million in that account. There, eventually it'll get increased up to over $1 billion.
Right, and is that invested, or is it
Yes.
earning
Yes,
our
it's earning
generous
interest.
CD rates from the banks?
Yes, yes, it is.
So did we have a billion in the fund before the pandemic?
I believe so. I don't have the records in front of me, but yeah. And so basically they kind of took funds out of there to cover operational costs at the beginning of the pandemic. But when the economy, during the pandemic, we were seeing a lot of general funds, that funds were sitting in the general fund. So to set it aside, they have to actually take some action.
So why does the Constitution know that 300 million that went out shouldn't have been put in the rainy day fund, or?
That was in addition to. So that is up to the legislature as far as the refund portion. And the 500 million as well was legislative action. They actually appropriated 500 million out of the general fund to restore funds to the rainy day fund. And when there's an emergency, the legislature has to take action to actually draw money out of the emergency reserve fund to be expended to help the economy.
Or to pay the bills.
Yes, basically. keep
That helps the
things-
economy.
Yeah, keep
Yeah.
things operational.
Yeah,
The-
at the beginning of the pandemic, there were concerns about cash flow.
Yes,
Because basically the economy stopped and tax revenue stopped for a while.
yes. So I also understand that the state actually borrowed funds, issued bonds.
Yeah.
To help cover. But then when the economy kind of turned around, and nobody really knew exactly what was going to happen to the general fund balances, then they started looking at restoring those funds. The other item I wanted to look at was on table 5A. There is okay, hang on a second. There, under federal funds in fiscal year 23, there's under federal grants, there's an increase in fiscal year 23, and that's primarily due to a revised projection of federal medical assistance payments that's funded through DHS. And that's about 489.2 million. So I just wanted to kind of point out the real large numbers. And that's the last that's the last of the items.
Any questions, for Mr. Chan? Okay. Thank you, Mr. Chan. Any
Thank you.
motion to approve Mr. BNF's report?
So moved.
Okay,
Second.
Okay, second. Okay, motion to approve the report by Mr. Chan and BNF. Vice Chair Newell,
Yes,
Mr. Saidar,
Yes,
Dr. Bonham,
Yes.
Councilmember Maynard,
Yes,
Councilmember Hayashi,
Yes.
Councilmember Lee.
Yes.
So the report by BNF and Mr. Chan is unanimously approved. The last item on the agenda is the next meeting. And when is the deadline? Is it March 15th, Dr. Kobe?
Yes, it's March 15th.
You know when House Finance's deadline is to, I guess, transmit the initial draft of the budget?
I don't know, but I do know that the reason that they do have the March 15th deadline is for that reason.
Yeah.
No, but it's mostly if we did something dramatic to the revenues. I mean,
it could happen.
It
Never
could
know.
happen.
We want to meet on the 9th or?
What is the March 15th is what day? It's
Wednesday.
so Wednesday.
I will be out of the office. I'll be getting married that weekend. So if we could do
Oh,
March,
congratulations.
thank you.
Congratulations. Wow.
Congratulations, Dr. Kobe. When are you out the whole month?
No, just I'm getting married on that Saturday. So if we could do it on the 8th, it'd be that works best for me.
Eight is, how's that for everyone? Is
Eighth is a Wednesday, right?
Yes.
We're
Yeah.
talking March 8th.
Yeah, March 8th, 2 o'clock.
I wouldn't be able to do it Wednesday, but I could do it Tuesday.
How about
the
Tuesday, March 7th?
Works for me.
Okay.
March 7th, 2 o'clock? Is that good for everyone?
Yeah.
Yes.
Yep.
did you say March 7?
Mhm.
Yes, Tuesday, March 7th.
2 o'clock.
And this is general fund, right?
Yeah, general fund.
Okay.
Is it okay with everyone else? So
Yeah.
the next
Yes.
general fund meeting will be March 7th at 2 o'clock. Okay, thank you, everyone, for the meeting, and Happy New Year and all the best.
Happy New Year.
Thank
Thank
you.
you. Happy New Year.
everyone.
Happy New Year to everybody.
Oh,
Thank you.
Seth, can I ask a quick question? Some of us are gubernatorial appointees. What's the status?
You guys are gubernatorial appointees, as far as I know, for an explicit term, which I would have to check. And
Yeah.
so you guys are fine until your term expires.
But
Okay.
that is.
I thought it
we
expired
all
with each
expire
new governor.
this
Yeah.
year.
Does
Yeah,
it?
that's it.
I'll look into.
I
I
think-
don't know.
Yeah, our term expires June 30th of
Yeah.
this.
Of 2023.
I think
Wait,
all of us.
think
all of
Oh,
us.
every-
yeah, because we're all, the
expires.
rest of us have 2-year terms, right? But the
Yeah.
governor appointees, I think, get 4-year terms. So
But I
but I
think
don't know if it's cut
everybody's,
off by the,
everybody's
new
up for
governor.
reappointment this year.
okay.
Okay. All right.
I
Thank you.
think I'm due for a vacation.
I could say
thank-
the same
thank
for
you,
me, but
everyone.
that would really be bad.
Bye-bye.
Okay,
Okay. Bye-bye.
Thanks, everybody.
Thank
Bye-bye.
Happy New Year.
Okay. Said you get us the draft, Marilyn and I, the draft tomorrow.
Yeah, I'll get you the draft today, and I'll
Okay.
also get you that the PowerPoint tomorrow morning as well.
Okay, okay. And when you
Mhm.
send the draft of the PowerPoint for next Tuesday, can you also send it to Vice Chair Newell?
Yes. Mhm.
Because I'd like your comments too. Yeah.
Okay.
Okay.
All right.
Okay.
Bye-bye.
Okay, thank you. Bye, Kristen.
Bye.
Bye.